London shares have suffered their worst four-week period since October 2016 as the FTSE 100 index took another 1.4% hit today. The latest fall for the blue-chip index to a level of 7,337 meant that it is down 5.8% from its mid-January peak just above 7,780, amid a widespread sell-off across global stock markets. Major indices around the world continued their falls of the week before, with the vast majority of companies on the Footsie posting losses. The FTSE All Share, meanwhile, which also fell 1.4% today, has lost nearly 6% since its peak 4,270 in mid-January, and looking at monthly performances, it has just had its worst month since October 2016 according to Hargreaves Lansdown analyst Laith. U.S. markets also opened lower on Monday, with the country's biggest index, the S&P 500, posting a 1% fall, before recovering some ground as the day wore on. It followed a sell-off on the S&P on Friday, which led to its biggest one-day loss since last September. The Dow Jones Industrial Average also suffered, posting its biggest decline since June 2016. The Stoxx Europe 600 was on track for its lowest close since November 2015 after losing 1.3% on Monday and falling to 383.20. The global scale of the sell-off was clear, with Asia's biggest market, Japan's Nikkei Stock Average, falling below 23,000 for the first time in 2018 and closing down 2.5% on Monday. It marked the Japanese market's largest fall since November 2016. Losses across global markets have continued since the new year, but picked up on Friday afternoon after a better-than-expected jobs report from the U.S. which showed improving wage growth. It sparked fears that inflation would pick up and led to a spike in bond yields as markets began to consider the impact of the U.S. Federal Reserve raising interest rates faster than anticipated. The steady increase in bond yields had been ongoing throughout January, but the spike caused riskier assets such as company stocks to look less attractive to investors, who promptly began selling. There were fears the latest falls in markets worldwide could be the tip of the iceberg after more than a year of rising valuations and very little volatility. The next day after an unusually big sell-off is always a big test of a market's strength. A repeat of anything close to the 2% decline seen in U.S. indices on Friday could trigger a prolonged period of risk-off sentiment, said Jasper Lawler, head of research at London Capital Group, supporting suggestions further falls could follow. The markets had been slow to fully factor in the impact of a Fed decision to hike interest rates, which the central bank has strongly hinted is likely to occur in March this year, and so a sell-off was overdue, Archida's investment director Adrian Locock said. The market has had to adjust to reflect both the current plans and the potential for rates to rise even faster. This has led to a rapid change in sentiment. Where investors were looking at the positives of Trump's tax cuts, and were reassured by the Fed's take-it-slow policy. Both are now causing some concern. The tax cuts could end up causing the U.S. economy to overheat if it's already at full capacity, he added. While a sell-off might be expected, Laith believes it is not a sign of poor economic health. The economic outlook is still positive, he said. The tax reforms in the U.S. are supportive of corporate profitability, and earnings are still expected to grow in 2018, which supports market valuations. The tax reforms will have some inflationary impact, but outside of the UK, inflation has remained fairly muted.